Hello and welcome to Crescent Private Wealth's December 2025 market update. My name is Omar Bassal. Today we're going to be looking at the following topics. We'll begin with some economic news that's been released since our last report. We'll then discuss U.S. interest rates, followed by a discussion on U.S. stocks. We'll move overseas and discuss non-U.S. stocks. And finally, we'll wrap up with a discussion on gold. So, with respect to economic news, the employment report for the month of November was released, and it showed that the US economy added 64,000 new jobs for the month. However, the report also showed that the US economy lost 105,000 jobs in October. So, taken together, overall, it does suggest a weakening economic environment. The unemployment rate rose to 4.6%, and that is the highest level since 2021. The Supreme Court is expected to soon rule on the legality of President Trump's tariffs. Now, by and large, the market does not expect the Supreme Court to overturn the tariffs. However, there's a decent probability that they might in fact overturn the tariffs, which would be a seismic event. In other words, I think the markets would rally significantly, especially some of the retail companies, some of the companies that are affected most by tariffs, if the Supreme Court decides to overturn the President Trump's tariff. So if the Supreme Court does not overturn them, I don't think the market will react because it's what it expects. But there is the potential here for a major rally in U.S. stocks when they do rule, which will be, we don't know the exact date, they don't tell us, but is expected soon. The chart in front of you shows you the new jobs created by month in the U.S. economy, and you can see there in the month of October it did dip negative below zero, but then in November it dipped back above or rose back above zero. I would just mention that the government shutdown did distort a lot of. It made it more difficult to collect some data, and therefore some investors are not putting too much weight on that employment report. Let's discuss U.S. interest rates. So the weakening economic environment suggests that interest rates might be too high. So traditionally, or the Fed, the way they normally operate is that if the economy is weak, they lower rates to stimulate. If the economy is strong, they raise rates. But if inflation is high, that constrains their ability to cut rates. In fact, it may cause them to raise interest rates. So today, inflation is running approximately 3% a year. I would say that the most recent inflation report did seem suspect because of the government shutdown. Again, investors aren't putting too much weight on it because there were some data points that were unrealistic. I'll give you an example. The inflation report for the month of November showed like 0% rise in housing costs month over month, which is not normal. So the next month's inflation, the December inflation report, will be more closely watched. The Federal Reserve central bank in the U.S., they did meet in December and they decided to cut interest rates by 25 basis points. So the previous range was 3.75% to 4%, and they've lowered it to 3.5% to 3.75%. So this is a acknowledgement that the economy is weakening. The Fed is currently projecting that they will cut rates once in 2026. It's unlikely that that's correct because the chair of the Fed will be replaced in May of next year, in May of 2026, and it's likely the new chair will be much more dovish, meaning that the new chair will be more likely to want to cut interest rates. That's something the president has been adamant about. He's wanted to see interest rates much lower than where they are today. So this chart just shows you the Fed funds rate, that interest rate that the Federal Reserve controls, and you can see how it's oscillated from 2005. You can see how it rose up until the Great Recession, and then the Fed lowered it really from 5.25% to 0%. And then you can see it was at 0% for many years. Some people might say too long, and then you can see that they've they began raising interest rates in it's like 16, 17 time frame. And then when COVID hit, again, they cut rates back down to 0%. And then in 2022, they began that rate hiking cycle, and they raised it significantly because inflation was hitting, not record high levels, but levels that had not been seen in decades. So they raised it all the way up to, again, it looks like around 5.25%, 5.5%. And then they've recently lowered it down to a range between 3.5 and 3.75%. Let's discuss US stocks. So, as we stated last month, the pullback in US stocks that we saw in October, November um, did not mark the peak in US stock prices. And the reason that we did not feel that that was a peak is that it wasn't associated with any kind of major negative events. So, major negative events would be like clear recession, major layoffs, corporate defaults, bank failures. Those are really big warning signs. And we didn't see any of that. It was simply people are worried about, is there a bubble in AI? And that's just fear. That's not, real, um, like an economic event. US indexes finally moved to all-time new highs in December, and it was fueled in part by a Fed rate cut, continued optimism around the growth in artificial intelligence, and then earnings that were better than feared. So some of the retailers had pretty decent earnings results, and that prompted many investors to bid their shares up. For 2025, US stocks rose about 20%. So, what's in store for next year, for 2026? So, one thing that we should look at is the valuation. And so, let me explain that the chart in front of you highlights. What it's showing you is how much of the S&P 500 index is in companies that are expensive. So, expensive here is being defined specifically by those companies that have a what's called price to sales ratio above 10 times. Simple example is that if there's a Subway restaurant that has $100,000 a year of sales, then if it was valued for $1 million, that would be 10 times its sales. So that's how to think of it. And so 10 times is a pretty rich valuation, and typically only reserved for very, high growth companies. But what we're seeing in the S&P 500 index is that around 33% of the index by weight is in companies that have a valuation greater than 10 times. So, and you can see here that this particular chart it's very useful. It's from a firm called GMO, going back to 1965. Generally speaking, there was only one other time where valuations got that expensive for the index, and that was in 2000, and that was the peak of the tech bubble. For many years at least. And you can see now that we're basically above the peak that was reached in 2000. So certainly this is not an encouraging sign to be optimistic on US share price performance. Keep in mind that unless there's a recession, typically the markets can still rally even if stocks are expensive. Let's look at non-US stocks now. So non-US stocks, so this is being defined as global ex-US, rose about 30% in 2025. So actually more than the US market, driven by a weaker dollar, lower valuations than the US market. In particular, what we're seeing is that earnings growth in emerging markets, so that's like Brazil, Russia, India, China, etc., is expected to be actually higher than developed markets. Developed markets being Western Europe, Japan, Australia, US. So despite the outperformance of non-US stocks over US stocks in 2025, there remains considerable scope for continued outperformance of non-US stocks. So this particular chart from Bloomberg I thought is very beneficial, very helpful. So what it looks at is the spread or difference between the global ex-US, so global stocks excluding the US, minus the US. So if we look at the far left, you can kind of see that in 2000, looks like 2002 through 2007, non-US stocks, non-US stocks outperformed US stocks. And you know that because those orange bars are above zero. So the when they're above zero, that means that non-US stocks exceeded US stocks. When it's below zero, it means US stocks outperform non-US stocks. So from 2002 to 2007, non-US stocks was the place to be. And then you can see in 2008 and 9, you have some kind of rotation, like one up, one down. And then really from 2010 all the way through 2024, it's just basically been the US stock market. That's been the place to be. And you can see that because all those orange bars are below zero, meaning that the US market outperformed the non-US market. And then you see in the far right, that 2025 bar, the white bar, that's above zero, not only above zero, significantly above zero. And so I think, this is just my view, that we might be entering another phase or period similar to what we saw in 2002 to 2007, where the non-US stocks outperform US stocks. We just saw a chart showing how expensive the US market is. And so it would probably be unlikely that the US market is now going to take the lead given how expensive it is today. Another chart that I thought would be useful to share is the expected earnings growth. So this is from Bloomberg. It shows you expected earnings growth for a couple of different regions. Let's look at this. Let's start in the far left. The first one is looking at Europe. So the lowest earnings growth expectations for 2026 is actually in Europe. European companies in general are expected to grow much slower. And then the second grouping is the global ex-US. So you can see here that it's growing a little bit better than Europe. And then the third grouping, the S&P, that's the US market. So the US market is expected to grow a little bit better than that global ex-US. But the highest growth markets are actually expected to be emerging markets. Again, that's the Brazil, Russia, China, India crowd. And you can see how much higher it's expected to be. Now, obviously, look, just because earnings growth is higher in a region doesn't necessarily mean that the stock prices of that region will be better. And just because earnings growth is lower than a region doesn't mean that the stock price will be lower in that region, because the European market, as an example, while it might have a small, while the earnings growth in Europe might be a little bit lower than the US, its valuations are significantly lower than the US. So for that reason, don't necessarily think that this translates directly into stock price performance, but it is a good, useful data point when you look at valuation, when you look at earnings growth, to understand the picture that's forming. Let's discuss gold. So gold was one of the best performing assets in 2025, rising about 70% in US dollar terms. It's important to mention the currency because you can look at gold in euro, yen, you can look at gold in any currency in the world. And the returns of gold will be different in those currencies. So we're talking specifically about the US dollar. Its appreciation will be less in other currencies because many other currencies actually did better than the US dollar. Now, the rally in gold has been fueled by central banks around the world buying gold. That's one factor. Exchange traded funds, or ETFs, has been another factor. Despite the rally in gold prices for 2025, we believe many factors suggest that gold may continue to rise over the longer term. So I thought it would be useful to share one or two charts here. This first one is showing you the net accumulation of central banks of gold over about a 24-year period. So looking at over 24 years, how much gold was purchased by some central banks. And you can see here that it's been substantial for Russia and China over that 24-year period, because this is actually tons. So they increased their exposure to gold by 1,948 tons over that 24-year period, which is substantial. China, similar level. And then you can see here India, Turkey, Poland, Kazakhstan, Saudi, Thailand, Mexico. Many of these countries have been increasing their exposure to gold. Now, one small thing I should mention is that this is what is reported by the countries. Some people believe, with I think there's some basis, that some governments are not reporting this data correctly, and it would make sense. So if I'm China and I'm buying a lot of gold, I don't want to tell people that I just increased my exposure by 3,000 tons, because that could cause the price to go up. I would probably want to not disclose everything if I could, legally. So just to keep that in mind in terms of the countries reporting this. And this chart shows you the share of gold in global central banks reserves. So what are we looking at? We're looking at all the different central banks in the world, how much dollars they own, how much euros they own, how much Japanese yen they own, how much GBP, Great Britain pounds they own, how much gold they own. And so you add all those numbers together, and you can see, you can calculate a percentage, what proportion of a central bank's reserves are in dollars versus gold, or dollars versus euros, et cetera. So you can see that in 1999 that the amount of dollars that the central banks had was around 60% of, again, we're looking specifically at their currencies plus gold. So about 60% was invested into the dollar. Um, and then you can see here that a smaller amount was in gold, maybe 20%. Euro was maybe 15%. And very little was invested in, say, the Japanese yen or the British pound. But what you see over time is that over time the numbers have been fluctuating. The dollar has been kind of declining. You can kind of see that euro initially was strengthening, and then after the European financial crisis in 2010, it kind of weakened. What really changed was in 2022, and we've discussed this a number of times. But when Russia invaded Ukraine, and the U.S. decided to freeze Russian assets, the other countries in the world started to get nervous about what happens if the US decides to freeze our assets. And so a lot of countries have been quietly, and now maybe not so quietly, shifting their reserves into gold because it's safer from the perspective of the gold. The US can't necessarily confiscate the gold that central banks have, whereas if it's in dollars, they can confiscate it because they can control the movement of dollars and settlement of dollars across the world. So this is another factor that is really contributing to that major rally we've seen in gold prices. And again, we believe there's good scope that this can actually continue. I'd like to thank you all for listening for the presentation, and we look forward to the quarter one report, which will release, God willing, next month.